Hi, welcome to this explainer series on Indian REITs, SM REITs and InvITs brought to you by ALT. Real Estate Investment Trusts, or REITs, small and medium REITs, or SM REITs, and Infrastructure Investment Trusts, or InvITs, are SEBI-regulated investment vehicles that allow investors to own a portion of income-generating real estate and infrastructure assets. Together, these investment vehicles have democratized access to asset classes that were once accessible only through direct ownership or blind pool private equity funds, while offering the income stability of real assets combined with the liquidity and regulatory safeguards of capital markets. In this video, we will dive deep into understanding how REITs and InvITs are transforming real estate and infrastructure investments in India. Let's start with REITs. Structured under the Indian Trusts Act, 1882, REITs, or Real Estate Investment Trusts, pool investor capital to purchase and operate portfolios of commercial real estate, such as office parks, shopping centers, and other income-generating properties. But why invest in REITs? Without the hassle of buying and managing real estate directly, investors can buy REIT shares on stock exchanges and earn returns through regular rental income and property appreciation. REITs have stringent regulations and governance as they operate under SEBI regulations. REITs must invest at least 80% of their assets in completed income-generating properties and distribute at least 90% of their net cash flows to unit holders. Listed on stock exchanges, REITs provide transparency, liquidity, and regular disclosure. The trust structure allows for tax pass-through benefits, avoiding double taxation, and ensuring that most cash flows reach the investor. Now let's explore the market evolution of REITs over the years. Originally introduced in the US over 60 years ago, REITs have grown to encompass over $500 billion in gross asset value across 150 listed REITs. This success inspired the UK, Singapore, Japan, Australia, and ultimately India, where SEBI introduced REIT regulations in 2014. In 2019, India witnessed its first REIT listing, Embassy Office Parks, which marked a pivotal moment for the nation's commercial real estate market. Since then, 4 more REITs have been launched in India: Mindspace Business Parks REIT in 2020, Brookfield India REIT in 2021, Nexus Select Trust in 2023, and Knowledge Realty Trust in 2025. Currently, there are 5 listed REITs in India with a combined AUM exceeding $27 billion, owning about 175 million square feet of Grade A commercial real estate across major cities, with a total market capitalization of almost $20 billion, reflecting the equity value that investors ascribe to their rental streams. The sectoral composition of REIT assets is currently skewed towards office real estate, roughly 80 to 85% in office assets like IT parks, corporate office campuses, with the remainder in retail malls and some hotel components. From an investor participation standpoint, REITs have seen rapidly growing acceptance. There are now over 260,000 plus REIT unit holders, up from just 6,000 in 2019, a base that includes large institutions like sovereign wealth funds, insurance companies, mutual funds, as well as tens of thousands of retail investors. Receiving quarterly distributions. Coming to performance, the current REITs have maintained high occupancy and growing rental incomes, leading to robust net operating income, or NOI growth. In fiscal year 2025, the 5 REITs collectively posted an NOI of over 85 billion rupees, distributing over 60 billion rupees to unit holders in fiscal year 2025, underlining the sector growth. Therefore, REITs have transformed the market by providing retail and HNI investors access to high-quality real estate and consistent income, making institutional-grade properties available to all. Now let's talk about SM REITs. In March 2024, SEBI rolled out a framework for SM REITs, specifically to bring fractional ownership real estate platforms under the ambit of REIT regulations. But what makes SM REITs different? An SM REIT functions much like a regular REIT, but on a smaller scale. While regular REITs invest in large-scale properties, SM REITs focus on small to mid-sized assets. The regulatory and taxation guardrails mirror those for larger REITs, with tweaks to suit smaller assets. Unlike traditional REITs, where investors put money into a blind pool of assets, SM REITs allow you to choose specific asset-focused schemes based on your goals. At least 95% of the scheme's assets must be invested in completed rent-generating properties, with mandatory quarterly distributions. There is a minimum investment of 10 lakh rupees for individual investors. The fund manager must invest 5% to 15% of the scheme value, and managers must have a net worth of rupees 20 crore, with at least rupees 10 crore in liquid assets. How do SM REITs work? The SM REITs investment manager sets up and manages a trust, with an independent trustee being appointed. This trust can launch multiple schemes akin to sub-trusts, each holding one or more properties worth rupees 50 crores to rupees 500 crores, offering a more direct, property-linked investment model. The SM REIT market, while fairly nascent at this stage, is expected to grow over 10 times, reaching rupees 375 billion by 2030, as per a joint report by JLL and Property Share. As of October 2025, there are 6 registered SM REITs in India and 2 listed schemes, PropShare Platina and PropShare Titania, both listed on the Bombay Stock Exchange by Property Share Investment Trust. While REITs and SM REITs focus on income-generating real estate, InvITs apply the same trust structure to infrastructure. Let us now understand how InvITs work. Infrastructure investment trusts, also known as InvITs, are also structured as trusts under the Indian Trust Act, 1882. They pool investor funds to purchase and operate portfolios of infrastructure projects such as highways, power transmission lines, warehousing parks, telecom towers, pipelines, or renewable energy projects. Returns are earned from user fees or tariffs generated by these assets. But why invest in InvITs? InvITs are a unique asset class that provide a hybrid investment option, combining the characteristics of both fixed income instruments and equities through dividend distributions, plus unit price appreciation. Through InvITs, investors can diversify their portfolios beyond conventional asset classes, as they typically exhibit low correlation with stock market movements, making them a good hedge during subdued market conditions. Additionally, as India's real estate and infrastructure sectors continue to expand, the demand for high-quality assets is expected to rise, supporting long-term value appreciation. InvITs must adhere to stringent regulations mandated by SEBI. They are required to distribute the bulk of their cash flows to unit holders and operate within prescribed limits on leverage. Regulations also restrict speculative development, making InvITs a more stable investment option. SEBI ensures regular valuations, governance standards, and transparency for InvITs, making them a trustworthy choice for retail and HNI investors. Coming to the market evolution, InvITs were introduced in India by SEBI in 2016, making high-quality infrastructure investments accessible to the public. The first InvIT, the IRB InvIT Fund, launched in 2017 and focused on toll road projects. Since then, InvITs have evolved rapidly. IndiGrid Trust launched in 2017, Power Grid Infrastructure InvIT in 2021, Indus InvIT in 2024, followed by Capital Infra Trust and Anantam Highways Trust in 2025. SEBI and the Ministry of Finance have been highly supportive of REITs and InvITs, progressively updating regulations and guidelines to address practical challenges. For example, SEBI reduced the minimum investment requirement in REITs and listed InvITs to a single unit. REITs units range from rupees 300 to rupees 400, and InvIT units range from rupees 50 to rupees 150. The Ministry of Finance also clarified the tax treatment in 2020. Interest and rental income portions of the REIT distributions remain taxable for investors, but any dividend from underlying SPVs and debt amortization payouts are tax-exempt in the hands of investors, which continue to keep the post-tax yields attractive. Moreover, the government consistently supported REITs to deepen capital market participation, allowing employees' provident fund and domestic institutions to allocate funds. In the current market landscape, there are 6 publicly listed InvITs in India and 21 more privately placed or institutionally held InvITs, spanning sectors such as roads and highways, transportation, energy, warehousing, and telecom. These listed and unlisted InvITs manage about $80 billion worth of infrastructure assets nationally, with the listed InvITs having a combined market capitalization of around $4 billion. Coming to sectoral composition, road projects form the single largest category of InvITs assets, with 40% of AUM, followed by power transmission and other segments like renewable energy, telecom, gas pipelines, and logistics facilities. By 2025, total InvIT unit holders reached around 280,000, with the 6 public InvITs collectively posting gross revenues of 43 billion rupees, distributing roughly rupees 17.8 billion to investors. Today, REITs and InvITs have reshaped how we invest in real estate and infrastructure, truly democratizing access to high-quality assets while offering regular income with the benefits of liquidity and transparency in regulated structures. You can invest in these unique assets through our Portfolio Management Service, or PMS, which offers active portfolio management by an experienced investment team, creating a customized portfolio based on investor objectives and risk profile. To learn more, log on to altinvest.ai today.